Hello and welcome to another Smooth Economics video. In this video we'll be looking at demand and marginal revenue, and this video forms part of our wider revenue topic. So demand and marginal revenue, to start off then a quick recap, what is shown by the demand curve. The demand curve shows the quantity of an item that consumers are willing and able to pay at any given price. In lower 6 micro, the demand curves that we studied were graphical representations of the total demand in an entire market. But now as we move into the upper 6 content, we must consider the demand curves for individual firms, which is the same as the individual firm's average revenue AR curve. You can see more about this in the Intro to Revenue video. The key analysis then, the demand curve is important in understanding marginal revenue. It shows us how much a producer has to lower his price in order to sell one more of an item. The steeper the demand curve is, the more a producer must lower his price in order to increase the quantity demanded, and vice versa. So if it's flatter, they don't have to reduce their price by as much. When we make the assumption of uniform price, i.e. that one single price is charged in the market for all consumers regardless of their individual willingness to pay, WTP, total revenue is clear in a firm's demand curve as the area of the rectangle between the point of the demand curve and the price and quantity axis. So if we had a price here and a corresponding quantity here, say that price is £10 and that quantity is 2, the revenue is 10 times 2, £20. Marginal revenue can then be seen as how the area of this rectangle changes as we increase the quantity incrementally. So say we cut our price to £9 per unit and we now sell a quantity of 3. So we're incrementally increasing our quantity by 1 unit. Our revenue has changed from 10 times 2 or £20 to 9 times 3, £27. Our MR, our marginal revenue from this increase in quantity would be £7, £27 minus 20. Moving on then to looking at the graphing of our marginal revenue function. Marginal revenue then, to recap, the addition to total revenue from selling one more unit of output. How much extra money the firm brings in from selling one more unit. Recapping that marginal term then, that refers to the incremental change to one variable, in this case the change to total revenue, from an additional unit to another, in this case an additional unit of output sold. Our equation for marginal revenue is MR equals change in TR over change in quantity. That delta, that triangle symbol, that means change in our equations. MR is the gradient function of the total revenue curve. It is the differential of the total revenue function. So then, to look at the diagram for marginal revenue, the marginal revenue curve is always below the demand curve when the demand curve is downward sloping. Our blue line for MR is always underneath our red line for demand. This is because when a producer has to lower the price in order to sell more of an item, the marginal revenue is less than the average revenue, as the producer also lowers the price for all the previous items they were selling. If you consider this price here, say let's call that £8, and we're selling a quantity of 4 units. If we then cut our price to £7 in order to sell 5 units, that margin revenue isn't just the extra £7 bought in, but also we have to consider the £1 we've lost on all those previous 4 units where we've got previously selling them for £8, but we're now selling them for 7. So our marginal revenue isn't £7, but rather it's £7 bought in minus the £4 lost on previous sales. Our marginal revenue in this case is only £3. In the case of a straight line demand curve, it turns out that our marginal revenue curve has the same intercept on our price axis, so MR and AR always start at the same point on the price axis, but the MR curve is twice as steep. This point here is half the distance from the origin as this second point here. And this is illustrated in a supplementary video as well. Key questions then. Why does the MR curve go below zero? Firstly, we need to remember that MR is downward sloping. As for firms to continue to increase sales by 1 unit, they must cut the price on a continuously increasing number of previously sold units. i.e., to increase sales to 5 units, the firm has to sell the previous 4 units at a lowest price. To increase sales to 6 units, it must cut the price of the previous 5. So to carry on increasing the number we're selling, we have to carry on increasing the amount of units we're cutting the price of. So that's that detrimental part we were looking at here to our total revenue. Eventually, there will come a point where the revenue gained from the extra sale is outweighed by the revenue lost from cutting the price of the previous units. Hence, the total revenue is reduced despite selling more output. Our MR goes below zero, this negative part of our MR curve. Where is total revenue maximised? Total revenue max occurs where marginal revenue is equal to zero. This is this point here, where the MR curve intersects the quantity axis. Any more output and MR becomes negative, dragging down our total revenue. Any less output, the firm is not making units which would add to its revenue. It is missing out on output with positive marginal revenue. The area of the rectangle, sandwiched between the AR curve, the price axis and the quantity axis, is maximised at this point where MR is equal to zero. Any other quantity, the area of that rectangle would not be as big, and that rectangle member tells us our total revenue. Therefore, if that rectangle is smaller, we're making less total revenue. Furthermore, this point here is also the point where our demand curve is unit elastic. And you can see the PED and the revenue video in our elasticities content to have a look at that concept. What level of output would a firm produce? In short, we don't know enough yet to answer this question. A revenue maximising firm would produce at the point where MR equals zero, i.e. where total revenue is maximised. However, revenue maximising isn't the only objective for firms. Most tend to be profit maximisers, but there are other objectives such as sales maximising that firms may wish to pursue. High revenues are important to finding out where a profit maximising firm would produce, but cost considerations are very important too. But what we are able to determine is that any price setting profit maximising firm will produce at a quantity somewhere to the left of where MR equals zero. And we know this is the case as it would be possible for a firm to produce a quantity greater than this point, get the same revenue as anywhere to the left of it, but that production would incur greater costs and therefore less profits for the same revenue. Thanks for watching this Smooth Economics video. Don't forget to subscribe to our channel. You can also visit our website www.smootheconomics.co.uk. Here you can find more resources, extension materials, details of upcoming courses, competitions and much more. We are also on social media. Follow us on Instagram, Twitter and Facebook with the handle @SmoothEconomics. Thanks again for watching, and we hope that you continue to enjoy our videos into the future.